This is not to sound like a broken record, but nearly everyone, me, you, and yours, have had at least one heartbreaking rejection from the big banks. I am not talking about a job rejection, but a proper loan or credit card application rejection. Tell me your story in the comment section. Comment the word rejection if something similar ever happened to you. At the end of this video, you will understand 3 key things. Number 1. The traditional banks are not your best friends when you are in desperate need of credit. Number 2. You can get up to $1 million in personal or business credit. Number 3. You have more credit options than you thought. Now, let's talk about how alternative lending got its popularity in 21st century finance. Welcome to Ivory Finance, a place where we show you the road when it gets tricky financially. What do you do after a famous rejection? Stand there and cry all day or seek an alternative solution? The latter is a better way to go. At some point, people got tired of the traditional bank's shenanigans with credit approval and credit collateralization. Alternative lending might sound new, but its roots go back decades. In fact, informal lending circles have been around for centuries in various cultures. But modern alternative lending started gaining traction in the early 2000s. It was around 2005 when the first peer-to-peer or P2P lending platforms, like Zopa in the UK and Prosper in the US, were launched. They introduced a new model where individuals could lend directly to others, bypassing traditional banks. By 2010, alternative lending had grown rapidly. The 2008 financial crisis led banks to cut back on consumer and small business lending, while new regulations made capital more expensive for traditional banks, putting pressure on their usual business models. In response, platforms like Lending Club in the US stepped in to fill the gap, allowing borrowers to access funds directly from individual investors. Fast forward to today, and alternative lending has grown into a $350 billion industry globally, with continued expansion in the US, Europe, and emerging markets. These small-volume credit experiments leveraged marketplace models alongside technology-enabled customer acquisition, underwriting, and loan servicing, geared to borrowers who had grown comfortable with online services. But what exactly is this marketplace model? Follow me. We will get there in a minute. To facilitate burgeoning loan volumes, alternative lending platforms evolved their funding models from the original peer-to-peer format to institutional buyers serving as the predominant loan investors, purchasing portfolios of loans in bulk. Hedge funds such as Fortress Investment Group, AQR Capital Management, Elliott Management, Oxif, now Sculptor Capital, Magnetar Capital, Blackstone, and Blue Mountain Capital were prominent buyers of alternative loans in the aftermath of the financial crisis. For example, Fortress Investment Group actively pursued corporate credit and asset-backed lending as part of its corporate credit strategy, deploying nearly $95 billion in loans and alternative credit solutions to various borrowers over the past 2 decades. Fortress's deep expertise in both distressed and asset-backed loans enabled it to perform well in non-traditional lending areas. Similarly, Blackstone has been involved in the credit sector through its private credit fund, BCRED, which allows it to participate in private credit markets, targeting corporate and syndicated loans for higher returns. These hedge funds were drawn to these platforms due to the high yields in a low-interest environment, alongside the flexibility to select loans individually, allowing for potential outperformance relative to platform averages. This strategy was widely adopted, positioning them as significant players in alternative lending markets. The first securitization, backed by unsecured consumer alternative loans, occurred in 2013, and the first rated securitization of those loans followed in 2015. U.S. consumer and small business alternative lending platforms first listed their shares publicly in 2014. The first registered alternative lending fund in the United States, designed to tap into the growth of alternative lending, was launched by Morgan Stanley Investment Management in 2016. Known as the AIP Alternative Lending Fund, this fund was structured as part of a master feeder system, which enabled Morgan Stanley to provide investors with access to alternative lending markets, particularly focusing on consumer and small business loans, originated through online lending platforms. This fund marked a significant step for institutional investment in alternative lending, as it allowed accredited investors to access diversified consumer and small business loans, offering an alternative to traditional fixed income investments during a time of historically low interest rates. In 2020, Morgan Stanley Research estimated nearly $10 billion of asset-backed security issuance by the marketplace lending sector. Bank of America Merrill Lynch Research noted that roughly 39% of marketplace loans originated in the US during 2020 were securitized. As illustrated, loan originations facilitated by consumer marketplace lending platforms increased dramatically during the 2010s. Originations dropped rapidly at the onset of the COVID pandemic, but started to rebound during the third quarter of 2020. Today, origination volumes have surpassed pre-pandemic levels as consumer and investor behavior normalized post-pandemic. So, what exactly drove the need for alternative lending? Let's look at the traditional lending system. In traditional lending, banks and financial institutions hold the keys to credit access. They rely heavily on credit scores, collateral, and extensive paperwork. While this system works for many, it often excludes people with limited credit history, lower incomes, or those who can't provide collateral. In fact, according to a 2017 survey by the Federal Reserve, nearly 40% of Americans had difficulty accessing traditional credit products. Small businesses face similar challenges, with nearly half of them being denied credit when they need it most. Let me take you to the UK. In October 2011, Christoph Riesch and James Deere were both working in finance when they noticed how small businesses were getting left behind by big banks. So they quit their jobs and put together a team to invent a new type of lending service using lightning-fast software. One that would give small business owners a great experience while getting the finance they need. The company is named Iwoca. They started exclusively with e-commerce businesses, but in April 2014, Iwoca began lending to all types of small businesses. By July 2015, it was reported to have seen 250% year-on-year growth in issuance. And you know what is more shocking? Iwoca only expects your business is based in the UK, a limited company or a partnership, basic details about the business and your business bank statements from the last year, and you'll get a decision in 24 hours for loans between £1,000 to £1 million. Show me one traditional bank that will not ask you for an arm and a leg for same amount of loan. I'll wait. This is where alternative lending comes in handy. With more flexible requirements and quicker approval processes, alternative lenders can step in where banks cannot. They use innovative models, often relying on advanced data analytics and machine learning to assess creditworthiness beyond just a credit score. Now, you may wonder, what are consumer finance marketplaces, and why do they matter here? Consumer finance marketplaces are platforms that connect borrowers and lenders. They serve as intermediaries, making the lending process easier, faster, and more accessible. Think of platforms like Lending Club, Funding Circle, and Upstart. They bring together individuals or small businesses in need of loans with investors willing to fund them. These marketplaces operate entirely online, which reduces overhead costs and allows for lower interest rates. For borrowers, financial marketplaces offer an alternative to traditional banks. For investors, they offer a new way to diversify portfolios. It's a win-win model, empowering both sides with more choices and flexibility. One of the most popular forms of alternative lending is peer-to-peer, or P2P, lending. In P2P lending, individuals lend money directly to other individuals or businesses through an online platform. This model cuts out traditional financial institutions, making it possible for people to access funds that would otherwise be out of reach. For example, if you're a small business owner in need of a loan, a P2P platform connects you directly with individual investors who want to lend. The P2P lending market is expected to grow at a compound annual growth rate of 25% from 2024 to 2032, reaching a value of $1.5 trillion by 2032. Here is the thing, the benefits go both ways. Borrowers enjoy fast approval and less rigid criteria, while lenders, often individual investors, can earn attractive returns. In a world where bank interest rates are low, P2P lending offers a valuable alternative for generating income. Alternative lending often provides unsecured loans. But what does that mean, and how does it compare to secured loans? In traditional finance, a secured loan requires collateral, something of value, like a car, home, or a piece of land, that the lender can seize if the borrower defaults. A mortgage, for example, is a secured loan. An unsecured loan, on the other hand, doesn't require collateral. These loans are based on creditworthiness rather than assets, making them more accessible to those without valuable assets. Since unsecured loans are riskier for lenders, they typically come with higher interest rates and APR. But alternative lenders have found ways to manage this risk. They often use AI and machine learning to analyze borrowers' credit score, income and employment stability, debt-to-income ratio, bank transaction data, alternative credit data like your rent and utility payments, behavioral and social data, digital footprint and device data, purpose of the loan, financial behavior history, employment, education history, and other data points. This allows them to make better informed decisions, even for unsecured loans, and helps keep interest rates competitive. The alternative lending ecosystem is made up of a variety of players. Beyond the P2P platforms and consumer finance marketplaces we've discussed, there are credit unions, fintech companies, and even big tech companies like Apple, PayPal, and Amazon, which have started offering financing options to customers in the form of buy now, pay later. Each of these players brings something unique to the table. Fintechs, for example, leverage data science and artificial intelligence to offer hyper-personalized lending solutions. Meanwhile, tech giants have the advantage of massive user bases and brand trust, which makes it easy for them to enter the lending market. This growing network of participants is creating a more inclusive lending environment and reshaping how people think about credit access. So, what does the future hold for alternative lending? With advancements in technology, the alternative lending market is set to grow even further. Experts predict the global alternative lending industry could reach $1.5 trillion by 2032, driven by increased internet access, digital transformation, and the rise of fintech. As more people turn to these platforms, alternative lending has the potential to democratize access to credit on a global scale, empowering individuals and businesses that the traditional system has overlooked. Thank you for watching. If you found this video insightful, please like, subscribe, and share. Let's keep learning and growing in the world of finance. Until next time.